Rick in Kissimmee is up next. Rick, go ahead. You're on with the Certified Financial Group.
Good morning, Rick.
Good morning.
What's up?
My question is, do you have any advice on borrowing money from your Roth IRA or your regular IRA?
And what is
if you're going to borrow money?
And what are you wanting to use the money for? Is it a new home purchase or?
Another home, yes.
Another home, not your primary residence, as an investment?
Yes.
Okay.
Well, would it be better just to sell or to borrow? I'm contributing now to my Roth IRA, but my regular IRAs, my 401ks, I'm not contributing.
Well, how long have you
IRA.
had the Roth IRA open?
Since 2013.
Okay, and just for our listeners, if you don't have it open for at least 5 years, that could have been a problem, but you're fine there. And one other question, how old are you? Are you over 59 and a half?
Yes, I'm 65.
Okay, all right. So if you're looking for taking money out as, I guess, a down payment for an investment property or a second home.
Yes.
Obviously, taking it from the Roth would not cost you any taxes. The reason we asked your age is just to make sure you wouldn't have a 10% penalty if you were before 59 and a half. And just for our listeners, for their primary home, if it's a first home purchase, you could have taken out $10,000 without a penalty, but that's the maximum. In your case, it's an investment property and you're over 59 and a half, so there's no penalty from the Roth. Of course, it won't be subject to tax. If you took it out of the regular IRA, you're simply going to have to pay income tax on it. So, you know, I typically like the Roth to not be touched, hopefully until your late 70s or 80s, so you get the compounding effect with no taxes. What do you think?
Well, once again, you can't borrow from it. You're allowed
Right.
one-time withdrawal, but you have to put it back within 60 days to avoid any taxes. So, you know, if that's your only source of cash, then you don't have any alternative. But Gary's 100% right. You want to use the Roth because that won't be taxable to you. And then you want to look at what your tax situation is. Taking money out of your IRA after 59 and a half, you want to look at what that does to you because whatever you take out will be taxed at your ordinary rates. So you want to do some crunching and see what that's all about. You know, you've probably seen it too, Gary. People come in and they taking money out of their 401k to buy their house, and they don't realize how expensive that money is.
It can bump them up into a higher bracket. So the first thing you would want to do is do a pro forma tax return to say, okay, if I took out X dollars, what's the impact on taxes? Does it throw me from the 12% tax bracket, for example, up into the 22% bracket? So you want to be mindful of what this is going to cost you. But as Joe mentioned, there's no borrowing. I mean, if you were looking for a short term, and to me this is dangerous. We've had clients do this and their circumstances have changed where they take money out of an IRA, they plan on rolling it back in 60 days, and then their circumstances changed, and if they did that, and especially for people under 59 and a half, all of a sudden now maybe they're paying 22% plus a 10% penalty. You're paying a third of that money if you miss that 60 days to get it back. So you know, my suggestion, because you are over 59 and a half, is to take out what you need, but make sure you look at the tax effects and make sure that makes sense and you have no other alternatives.
Now, one of the things that we've seen is people using self-directed IRA to buy investment property.
Right.
And the pros and cons of that deal.
Well, that's, you know, the same issue. If you buy real estate within an IRA, it's not liquid, right? And sometimes liquidity is really important because we don't know the future. We don't know when we need liquidity. And then there's cost involved, right? So you have to have an intermediary aid you in that transaction of buying property within your IRA account, and that can get expensive.
Right. And one of the beauties of owning investment property is the depreciation, which you lose in an IRA.
Right.
The deduction for maintenance, for insurance, for taxes, all those things are lost in an IRA.
Exactly. So, as you said, the beauty of investment property is being able to write off losses oftentimes due to depreciation, and you lose that.
Or not just the losses, but also just the income, because you can have tax-free income, so to speak, because the losses will offset that income. So there's ways to do it, but you got to be careful. And this is what we do day in and day out. Certified Financial Group, working with our clients as certified financial planners, practitioners. Not only do we manage money for a fee, but we have built this business on doing financial planning and answering those questions. But we appreciate your call and hope we answered your question.
All right, thanks so much, Rick. If you want Rick's line, it's 844-220-0965. That's 844-220-0965.